Welcome, everyone. Thank you for taking the time to join us. Today's webinar, we're going to focus on the high demand opportunities and trends within self-storage syndications. It is top of the hour, and I do want to be respectful of your time, so let's just get started. I'm Reneika Lightbourne with Advanta IRA. I'm honored to welcome industry expert Joe Pizzurro, founder and managing director of Breakchain Capital Investments. Thank you, Joe, for being our featured speaker.
Wonderful. Yeah, pleasure to be here. Thank you for having me.
You're certainly welcome. Joe is going to explain why investing in self-storage has become so popular, what syndications are and how they work, and then some of the many benefits of self-storage investing. But before I turn it over, I do want to give you a general overview of what self-directed IRA is and how they works. And then, of course, when you're ready to get started with Advanta, the process with us. If you have questions, you're welcome to put those in the question box. We'll actually answer as we go, and then allocate time at the end to answer any remaining questions. Again, I'm Reneika Lightbourne. I'm one of the business development specialists. I've been with Advanta as an employee since 2019, but I'm also an Advanta IRA client prior to joining staff. So self-direction is something that I strongly advocate both personally and professionally. After today's call, if you want to do a consultation, talk through your scenario, you're welcome to give me a call or send me an email or go to advantaira.com to schedule a consultation with myself or one of my colleagues. Just a little housekeeping before we get started. Just know that at Advanta IRA, we don't give any tax, legal, or investment advice. We don't endorse any particular products. All of the information that's presented today is just for educational purposes. As always, we encourage you to confer with your professional team, like your CPAs, attorneys, and financial advisors before making any investment decisions. If self-direction is a new concept for you, I just want you to just take away three simple points in that any IRA or former employer plan, like an old 401k, qualifies to be self-directed. 2, you get to choose you get to choose your investment. Today we're focusing on a real estate related asset and self-storage units. And then of course, all of the income that's generated from that investment flows back into your IRA. Just a little history about Advanta and who we are. We've been in business for over 20 years now as one of the leading self-directed IRA administrators in the business. While we don't give any tax, legal, or investment advice, our team is comprised of attorneys, certified IRA professionals, and MBAs and CFPs professionals. Our focus here at Advanta is, providing our clients that concierge-style service. So all of our clients do have a dedicated account manager that's with them for the life of their account with us. Our headquarters is located in the Clearwater, Tampa Bay area. Advanta, we do have an office in the Atlanta area as well, but we work with clients nationwide as we have a little over $3 billion now under our administration. And one of the things we pride ourselves on is that educational content where we have practitioners and experts like Joe come in and knowledge share with you. In addition to doing weekly webinars, we typically do about 2 a week. So I would encourage you to go to our website, go to our events page. You can sign up. You can recommend different topics. You can go to our YouTube channel. This is recorded. Look at our YouTube channels for previous webinars that we've done and also upcoming events. Our podcast, my colleague Alex Perney hosts a podcast, more informal but great content nonetheless. And also we have a blog, anything and everything related to self-direction. So exactly what is a self-directed IRA? Just very simply just means that you as the account owner, you're going to have complete control of your retirement funds. You have complete control over the investment decisions. You have essentially a blank canvas to be able to diversify outside of the traditional stocks, bonds, and mutual funds. We have clients that use their IRA funds to invest in the likes of real estate. Again, today we're focusing on self-storage, but you can do multifamily units. You can invest in a single-family home, whether it's for rental or it's a fix and flip project. You can use IRA funds to invest in precious metals, oil and gas, cryptocurrencies. The list goes on in terms of what's on the table for you and how you can diversify your account. Why do people choose to self-direct? You may look to self-direct for many different reasons. I'll just touch on 3 of them. 1, it could be a new source of capital. So instead of tapping into your emergency fund or taking out a bank loan, if you have funds that's sitting idle in an old 401k or an existing IRA, you can elect to use those funds. Most times we're not looking to use retirement funds until 5, 10, 20, 30 years. So if it's just sitting idle, you can elect to put those funds to work. If you're a capital raiser, it's a great way to pretty much essentially raise capital for your next deal. Another reason is the ups and downs, the volatility in the stock market. Some days is up, some days is down. We have no control over that. But with self-direction, you get to at least diversify into tangible assets like a self-storage that's known to garner consistent returns. And then the tax benefits, having those rents, those profits, those dividends flow back into your retirement account, tax deferred or tax free, depending on the type of account that you have. In terms of the different types of accounts that can be self-directed, it's the ones that you're already familiar with. So for individuals, you have traditional IRAs, Roth IRAs. With traditional accounts, you get the tax break. Up front. You grow that account over time. Once you reach retirement age and you take it out, that's when you pay taxes at that particular point, whether at 59.5 or RMD age. Whereas with Roth IRAs, you elect to pay the taxes up front. As long as you've held that Roth IRA account for at least 5 years and you're 59.5, those distributions will be tax-free. Some lesser accounts that are also just as important that can be self-directed are HSA. So if you have a high deductible medical plan, you can elect to self-direct your HSA, or you can look to self-direct an ESA. If you have kids or grandkids, you can certainly put those funds to work to cover their educational expenses. Plans that are specific to business owners and entrepreneurs are solo 401k, simples, and SEP IRAs. Solo 401ks, I know a lot of real estate professionals like the solo 401k because you have greater flexibility, higher contribution limits. So if that's of interest to you, you're always welcome to reach out to us to learn more about it. The main thing here is with solo 401ks and traditional IRAs, you essentially can have multiple accounts and you can partner those accounts together to do your investment. If you have a current employer plan, like a current 401k, and you're not yet 59.5, then most times that's where the restrictions would come in. But if it's an old employer plan or you have an existing IRA, you can elect to move those funds to partner and do your deal. In terms of funding the account, there are several ways you can fund, which includes transferring funds from an existing IRA. So it'll be a trustee to trustee transfer. There's no tax liabilities to do that. It's not even reported. It's just moving from one account. So for example, if you have an IRA at Fidelity or Charles Schwab, Advanta would submit that request over to the other custodian to get those funds moved over. You decide exactly how much you want to move. So it's, it can be a partial amount or complete. The other way you can fund your account is doing a direct rollover from an old employer plan. You would actually have to initiate that request. You're not taking a personal distribution, you're just simply moving it from one retirement account to another. That's also a tax-free movement of money, but that is recorded to the IRS. The other custodian will report, Advanta as the receiving custodian will also report to the IRS that we received the exact dollar amount just to neutralize. There's no tax liabilities there, but you as the client would actually have to say you're looking to move X amount of dollars. And then the other way you can fund your account is by making an annual cash contribution. The IRS just came out with 2025 contribution numbers, but for 2024, you can still contribute up until tax deadline, which is April 15 of 2025, or your extension. For 2024 and 2025, the numbers for traditional and Roth IRA remains the same. So if you're under 50, you can put in $7,000. If you're over 50, you have that additional $1,000 where you can possibly put in up to $8,000 as long as you've earned income. For SEP IRAs for 2024, the number is $69,000, but for 2025, we do see an increase in $1,000, so you'll be able to put up to $70,000 in a SEP IRA. For simple IRA, it's $16,000. It's going to go up $500 for 2025, so $16,500 plus $3,500 if you're over the age of 50. With a solo 401k, for 2024, you can put in $23,000. If you're over the age of 50 currently, you can put in an additional $7,500. But starting in 2025, if you're between the ages of 60 and 63, you actually have an additional, it's almost like a higher contribution amount of $11,250. So it's going to allow you to possibly contribute $81,000 plus in your solo 401k if you're between the ages of 60 and 63. For an ESA, the contribution numbers remain the same, $2,000 per year per child for 2024 and 2025. And then for an HSA, currently you can put in $4,150 for an individual plan, again, having a high deductible medical plan. For a family plan, you can put in $8,300. If you're over the age of 55, you have the additional $1,000 that you can catch up. For 2025 for an HSA, it's going to increase just a few $100s. So it's going to be $4,300 for a single HSA plan and an $8,550 for a family plan. So just be on the lookout for the increase in contributions for 2025. When you're ready to get started with us, the process is going to be pretty straightforward. You can go directly to our website, fill out the application to open up a new account. We can get your account open typically within 24 business hours, but the application process, the bulk of it, you can get it done within 15 to 20 minutes. Certainly, if you need assistance, we're here to guide you through it. Once your account is open, you do have an assigned account manager who's going to be with you for the life of your account, your point of contact when you're ready to make investments. And then step 2, funding your account is going to be a combination of making an annual cash contribution, transfer from an existing IRA, or doing a direct rollover from an old employer plan. And then finally, step 3 is making your investment. If it's something that you're interested, whether it's storage, self-storage units, or is it doing rental properties or oil and gas, you essentially get to use your IRA account to do just that. And with that, I'll go ahead and turn it over to Joe. So Joe, just bear with me one moment. Let me make you the presenter.
All right, so thank you for joining, everybody. That's me right there. Just a little bit about myself, and I'll get into the presentation. And please, if there's questions throughout, put them in the chat, and we can answer questions as we go. Just a little background on myself. I got into the real estate industry, well, technically back in 2017 with some single family rentals, but I started this commercial real estate investment company in 2020 and began acquiring apartments. And then eventually, a couple years after that, moved into self-storage. And the way I did those was through syndication, which I can spend a little time going over. But since then, I was able to acquire 9 self-storage properties, totaling almost 4,000 units and about 40 million of assets under management. Now, keep in mind that may sound like a lot, but the storage units can be very small, so those units add up pretty quickly. But still, it's a nice portfolio. We do look to acquire in Texas, mostly DFW area. But that's just a little background on myself. And so as far as syndications, one of the benefits of syndicating is obviously we can acquire a much larger asset than we could on our own by pooling together, our funds. And so the advantage is with commercial real estate. And now, obviously, commercial real estate is going to be more expensive, so it's hard to buy that on your own unless maybe you're saving your whole life. There's few of us that can do that on our own. So, but the benefit of commercial real estate is the way they value the property as compared to, for example, residential, like single family, is just based on comps. Whereas commercial, they take into the consideration the revenue that the property generates, or the net operating income, and that's how they value these properties. So even though the market may be in a decline and values may be dropping, there's still opportunity to raise the value on your property if you can manage it effectively and increase your NOI. You're able to increase value even during a downturn, like the past couple of years. So there's another level of resiliency with commercial real estate that is maybe not necessarily as strong with single family. So that's one benefit of syndicating, and also on the properties. Obviously there's advantages of tax savings. What we do what's called a cost segregation study whenever we close on a property. And that's basically just taking the 5, 7, and 15-year depreciable items on the property and accelerating that depreciation up front in the first year versus being stretched over, up to between 27 to 39 years. That was something that was passed in 2017 during the Tax Reform Act, which allows, I think it's every year it drops until it's supposed to expire in a couple years from now. But with the recent election, it may get renewed. I think currently 2024, you're able to realize up to 60% bonus depreciation, which means you'd be able to get about 60% of your investment back as a loss on your K1 form, which you can apply against passive income. And I would advise you to check with your CPA. They can obviously explain better than I can how that works. But if you don't have passive income, it would just roll over to the next year until you're able to use it. But you would just keep accumulating that loss on each year on your tax return. So that's another advantage. Let me go to the next slide. So I don't know how many of you guys have already invested in self-storage, or maybe apartments, or maybe not anything yet. Like I said, I used to do apartments, and I still do both. I like to have both in our portfolio. But some of the pros and cons of storage, as compared to apartments, there's a lot of pros for self-storage. It's a very powerful asset class. Let's start with the cons, just because they're the shorter list. Obviously apartments, they have more depreciation, they have more amenities, they have more, there's more there on the property. The self-storage is very simple. They're empty units, right? So there's not a lot of depreciation there. So that's something some people prefer when they're investing. There's also, because it's housing, you can use Fannie and Freddie agency loans, and you get a lower interest rate. Whereas with self-storage, you're pretty much stuck with either a bank loan or a CMBS loan, or if you can negotiate seller financing. The apartments appreciate in value. You're going to probably earn more equity in those. Again, depending on the market, there's a lot more apartments for sale out there to find. That's one thing that's more difficult to find self-storage properties. But as far as the pros, they can be purchased at much lower cost, like sometimes a tenth of the price. We just closed on a 500 unit property a couple months ago, and we paid 5.4 million for that. Whereas if I paid 5.4 million for an apartment, that would get me maybe 50 units. And it's easier to raise the money, right? Obviously, the larger the purchase price, the more capital you need, the more investors you need. So it becomes sometimes cumbersome to keep up with and to make happen. So they're easier to take down. One thing is the leases are month to month. So if I want to raise rent, for example, it's very easy to raise rents on a storage property because, like I said, there's more units usually. For the same price, I can get 500 units of self-storage. If I raise the rent by only $5 a month, that equates to like potentially 30,000 a year of NOI increase, which translates to 420K a year of value that you just created. And you can create that within 30 days. You can raise the rents on everyone there. You don't have to wait for a whole year as an apartment. You'd have to wait 12 months for all the staggered leases to renew before you can make that happen. So for the same purchase price, you get maybe a 50 unit property for an apartment, and a $5 increase, that's only going to yield you, something like 3,000 a year of NOI, right? And maybe 42,000 of value add, and it would take a whole year to achieve that. So you can do that very quickly with very small increases. So keep in mind that, if you own a storage unit, if you see that your rent got raised by $5 a month, is that enough for you to go move your stuff to somewhere else? Most of the time, probably not. So they're easy to get away with small little increases, but they make a big dent, a big impact. There's very low operating expense. So the expense ratio to self-storage is usually, around 30%, anywhere from 25 to 35%, whereas an apartment is more closer to 50%. So of course that creates more cash flow. They're easier to operate. They don't require as much staff as compared to an apartment. It's easier to remove non-paying tenants. There's no eviction process. Sometimes that can be a struggle with apartments, is getting people out who haven't paid. That can take up to 4 to 6 weeks, sometimes longer. So that's a lot easier for storage. You can actually auction off the belongings if of the non-paying tenants. And it's also easier the storage properties are more resilient in secondary markets as compared to apartments. Essentially, storage, it doesn't necessarily, you don't need like a huge population growth to really create a good market for storage, as long as there's a demand for. Usually it goes well with apartments, and I'll have a slide toward the end here that I can explain more about that. So some of the ways
a couple questions popped in. It says, how do you handle your property management for your facilities? Do you self-manage, or do you have a management company?
Great question. Yeah, so we do not self-manage. We use third-party management, and the reason for that is they're professionals. They've been doing this for years. They really can keep up with everything. If we're trying to do it ourselves, yes, we would save an expense, but we're not going to do as good of a job. Eventually we'll be stretched thin because we want to scale. We want more and more units, more and more properties. So we use third party, and they're not very expensive. It's usually about 4.5% to 5% of monthly revenue. So not too crazy. So we use third party management.
Okay, thank you. Next question is, you mentioned that you're located in Texas. The question is, what important market factors are you considering when selecting just being based in Texas, or are you looking to expand into other areas?
Great question. So I'm located in DFW, so I'm very familiar with this market. And Texas is just, to me, a safe place to invest as far as just all the population growth, job growth occurring here. It's just a good market for real estate in general. But as a passive investor, I invest passively as well. I'm open to any market as long as it makes sense. But if I'm raising capital from investors, I want to make sure I'm an expert in the market if I'm going to be responsible for investor money, right? So I try to stick with the Texas market because I understand it the best. But what I look for, so the couple most recent properties we acquired were very interesting, and what I'm liking about it is we kind of look for something that's not necessarily in the middle of a busy intersection in a busy city with lots of other self-storage around it. I like to find something maybe a little out a ways. The past couple we've gotten were near a lake. They have boat and RV parking on the property. So that's an added extra revenue stream that makes, you're not just selling storage units, you're selling, the storage of the boats and RVs. We also had U-Haul on the property. So those are just some other levers that can be pulled to, have more stability and reduce risk on the property. But yeah, something that's usually not in a oversaturated area where there's, not too much competition around you. So, those are kind of what we look for. And a little bit about some of the ways we add value. Now, what we typically do, We will factor in rent increases into our numbers when we make our projections, but other than that, we won't bake in too much more. We want to make sure the deal works without so many dependencies. So these are all more nice to have. So if we can implement some of these ideas that I'm about to go over, those are just extra savings on top of the returns that were already projected. Just in case, it also acts as a buffer in case we have another surprise, you know, in the economy that some of these things can offset and compensate for. So they're nice to have. You know, some things include converting units into climate controlled. Of course, we need to assess the demand for that. So on one of our properties now, we have a wait list for some climate controlled units. So that's great. Now, at least we know that if we build them, they will come, right? So that you want to make sure there's some demand there first. So that's an idea. Also adding additional units. So on one of our properties, we have a little apartment building where the previous owner was living there. Well, it already has all the AC, you know, set up. So we were wanting to maybe convert that into some units, some climate controlled units. So that's an opportunity. Again, we didn't factor that into the numbers, so that's just a nice to have if we're able to achieve that. I mentioned the boat and RV parking, adding covered parking. That's another thing we have some demand for on one of our properties. We have a wait list of, I think, 7 or 8 tenants that are interested. So we're going to build 10 more. We already have 10. We're going to build another 10, and we should be able to quickly get 70 to 80% of those leased out right away. I mentioned U-Haul rentals. That's something that's surprising. I didn't put it on here, but also merchandise, selling moving supplies. There's a lot of people that are using these things. They're using it when they move or during transitions. Or even as just regular storage, when they do finally move, it sometimes helps to sell those supplies. And you know, we're generating maybe $800 a month, give or take, on merchandise, which is not a terrible amount, but it's nice to have as well. Ice machines, you know, that of course it depends on the location. Being that we're near a lake on 2 of our properties, that makes sense. You know, people come there to get their boats or their RVs. There's an ice machine there. You'd be surprised, some of these properties. Another thing, to go back to that first question, what we look for is, so in general, we look for value add opportunities. So for example, if a property has already done all of these things that I'm talking about and their rents are already at the market rate, there's not much room to really add value quickly. We would then be having a different strategy of just holding and waiting. And that's fine too, because maybe if the property cash flows, it becomes a cash flow deal, but you're not really, like I mentioned in my example, you're not really able to add $500,000 of value by doing one small thing to the property. You know, so those are what we look for, is more properties that have opportunity for value add. You know, maybe that the mom and pop owned are good examples where they haven't done much to it. They don't really need to. They're fine with the money they're making on it. And when they're ready to sell, there's just tons of opportunity to add value. So those are things we like to look for, as well as seller financing opportunities. I was talking to a broker, a couple of storage brokers, that said close to 80% of the deals they closed this year were seller financed, because, like I said, you don't have too many other options for loans other than, you know, your interest rate's going to be 7 to 8%. So there's a lot of you know, owner financing happening in the self-storage area. But back to what I was saying, some of these properties, they don't even have a website or an online presence or a ability to accept online payments. So that's something to set up, where if you see the occupancy is a little bit low when you buy it, and there's an easy opportunity to push that occupancy, because you can set up the website, set up the online payments. So that's another opportunity. There's also the opportunity of automating the property. what I mean by that is you could reduce staff and eventually potentially eliminate staff at the property and save cost. And the way to do that is through remote access controls. So if you have security gates, the tenant would be given the password or the code to get in on the keypad. And then there's also locks. So the brand that we've used before on the keypads is called Spider. So essentially a tenant could go online, they could pay for a unit, you assign them the unit number and you give them the code to the access gate and the combination to their lock, and they can go there themselves, get in, find their unit, open the lock, and all without having anybody on site. And then when they move out, same thing, and then they return their lock to a Dropbox. So you could potentially automate the entire property. Now with the way we do it, we are looking at doing that, but we did not factor that into our numbers. We factored in fully staffed for the whole 5-year hold. We usually hold these things about 5 years. Now, if we are able to reduce staff, then that's just extra savings. So that's something we're looking at. We also implement tenant insurance, which is good for the tenants to have. It depends, again, on the third-party management. Some management companies will want to split that with you, and the premiums that you earn on it. Some you get to keep the whole premium. So that can net you anywhere from between $6 to $12 a month per tenant. So that's another thing we implement. Questions so far?
Yes, I actually have a couple questions that came in. It says, how do you typically structure your deals?
So the way I do it, and again, this would be a better question for a securities attorney, but basically there's 3 different ways to raise money. There's the Reg A, Reg D, and Reg CF. Reg A is typically more for like venture capital. You're investing in shares of a corporation. Reg D is more for real estate. So that's what I've done is Reg D 506B or 506C, which is either 506B is you're able to raise from non-accredited investors, but only a limited amount, and you need to have pre-existing relationships with the investors. 506C is accredited only, but you don't need to have the pre-existing relationships, so you can market on social media and etc. So typically for these, I do like a 506B. I just blast these out to my network of investors. And for anyone interested, please, at the last slide, I'll share my contact info and I can keep everyone up to date on any opportunities. I don't have any active at the moment, but that could change tomorrow. So we're always looking for new acquisitions. But yeah, we typically structure them as 506B. We typically would do, like a 70-30 split with our limited partners. And I have an example, actually. I think it's the next slide, or maybe the one after. I'll skip over this for now. Here's an example of an actual deal we had recently of the returns. So if you had invested 100,000 in this property, these would be kind of the expected returns on your investment. We did round at the total equity on sale. It was a little bit higher than that. We just rounded it down to a nice round number to call it a 2x. But yeah, you would expect to make on average about 10% over the 5 years cash flow, cash on cash, which is nice. And that's, keep in mind, during this downturn, it usually could be more than that in a good economy. But we typically, it still ends up around a 2x over 5 years, similar to our apartment deals. The difference is the self-storage, I would say, is normally like 50-50. Half your returns are going to come from the cash flow, and then the other half when we sell the property. Versus an apartment, it's more like 20% comes from cash flow, and then 80%, the majority of your returns comes when we sell it. Self-storage, you're going to get more cash flow, but it still ends up being close to the same overall return. Does that answer the question?
Yes, and that you actually answered the second question as well. What is the typical return for investor? You mentioned, typically on average 10% that you're saying for your clients. The next question is, are there any upfront or ongoing fees for investors?
Nope. No, that's the good thing. So to invest passively, and I do it myself as well. It's very easy. There's no upfront fees. You don't have to risk any earnest money. You don't have to sign any loans. You are essentially just becoming a shareholder of. So what we do, we create an LLC that will own the property, and you're investing in that LLC. So you're going to be a partner with an ownership percentage of that company that owns the property, and you'll get your share of distributions. We typically distribute monthly. So the way that usually works, once we close on the property, so in this example, we close on this property August 25th. Our first full month of financials would have been September. So once we close the month of September, which is usually the second week of October, we would then distribute our first distribution. So we sent out our first distribution, and we're about to do our second one here in a couple weeks. So we just do that monthly. And then, obviously, if you look at the slide, it'll start out a little bit lower, and as it increase over time. It won't be 10% the first year, but if we do better than that, we try to be conservative on these. We'll most likely exceed the 6.5 on year one. It may not be up to the 10% yet, but usually these projections are pretty conservative. But yeah, any other questions?
Yes, so two more questions. It says, well, you mentioned that you typically hold your properties for 5 years. It says, I'm sorry. Yeah. Okay, another question just popped up. It says you typically hold your property for 5 years. Do you generally, sell it, within less time, more time? And also, what's the exit strategy? Is it always to buy and sell, or do you hold properties?
Yeah, great question. So we typically will project a 5-year, and a lot of times what happens is what the real projection is to double your money. And if we don't think we can double your money, we usually won't do the deal, because in my experience, people have other ways of earning yield, and they may be getting 5 or 6% or in their 401k, but why would they move it unless it's an incentive, right? So we try to shoot for a 2x. So if we can 2x your money in 3 years, that's not bad, right? That's like 30%, more than 30% annual return. So we'll usually could sell it early, get everyone their money back, and reinvest it, redeploy it. So yeah, if we can hit the target projection early, then we would love to do that. It usually doesn't take longer than 5 years. So sometimes we would usually say 3 to 5. So on average 4. And what was the other part of that question, Reneika?
So another question just came in. It says, how do you handle a downturn in the economy with your units?
Well, and that's kind of happening now. So again, the good thing about this is as you push that NOI, it's just raising the value of the property no matter what is happening around it. Even if, so the calculation is you take the net operating income divided by the cap rate in that submarket. Even if cap rates are expanding, you can still increase that NOI. And so at worst case, you're at least keeping the values the same without it decreasing. But yeah, what we try to do is just implement our plan, get that NOI up, and try to just add as much value as we can in as short a time as we can. Because what we found is most investors, they like to get their cash out and get their liquidity, and then they can reinvest it if they want, or reinvest it in 2 other deals this time. I think the other question was about, are there other ways other than the sale? Yes. If, for example, this property is just doing really well, and if we're just cash flowing like 15%, maybe we want to do just a refinance and give everyone like a cash out, a partial cash out, and then keep holding longer. That would be something we could set up a call with all the investors and get everyone's feedback. Usually there's not too many investors in these storage deals, and we love to, we usually do like a quarterly Zoom call with our investors just to give them a face-to-face update and get their opinions on hey, we're looking like we're about to hit our projections. Do you guys want to keep holding and exceed projections, or do you want to sell now? And just get kind of the temperature from everybody. But yeah, that's another example, is we could do a cash out refinance and then continue to receive that cash flow.
Okay, next question that came in is, with a Nelly virtual online rental process, how do you manage liability, protect yourself from what tenants store in the units, example, contrabands, guns, and so forth?
Yeah, so something we always invest in is security cameras. We have remote access to those, and we do also have. I don't think we would ever try the staffless on all of our properties. We usually would maybe have it on one, and then have someone on one of our other properties nearby, and maybe they can go check on it, and maybe they can be there like once or twice a week, and at the other property the rest of the time. I don't think we would ever just have nobody at any of our properties in the area. So we'd always want to have somebody nearby. But yeah, we do always invest in the security cameras, license plate readers, and that is also a deterrent, and also LED lighting. So when you have the lighting and the cameras, it helps to deter a crime, as well as helps to catch the crime. And so that's something we found also, especially on self-storage, even more than apartments. Investors want to know that you have, budget for security factored in.
Okay, thank you.
Let me go back to this. So I think this was just an example of, we did rebrand that name, by the way. This was a property we just bought, about 70,000 net rentable square feet. So that's something that we typically go by in the self-storage world. We go by square footage to really gauge the size of the property versus units. Because again, some of those units can be parking, et cetera, and there's many different layouts, right? So there could be more than 20 different layouts of these units. So we go by square footage. So this particular property had, 488 units. Well, really 530 about something units, and the rest were parking spots, covered and uncovered. So we'll be adding more covered. And then, so here's just a slide about kind of the market and what we look for. So these storage properties typically do well nearby apartments. And what's been happening lately is with there's two things. With interest rates being high, not as many people are buying homes, and more people are renting, because it's hard to get a mortgage right now. So that's when you have more people living in apartments, like you're seeing on this slide, it creates more need for storage because there's less space in apartments. Most apartments don't have a garage. Some of them do, but you know, for people, a lot of people, they use their storage unit as their garage. They keep their bicycle in it. They keep their, maybe they have lawn equipment they're not using right now because they're not living in the house. They keep it in there. You know, so we find that the more, if there's a lot of apartments in the area, and that's a good place to either buy or build a storage facility. The other thing is millennials, or I don't know what the word is for the new generation, but it's not just referring to inflation that we're having the past couple of years, which is more excessive, but in general, back in the 90s, you know, you could buy a home for 100,000, a nice home, and that's not really doable these days. So a lot of younger people are renting apartments versus buying homes. You know, I was graduated in the mid 90s, and most of my age, we were buying our first home in our late 20s, and that's not happening as much these days. So there's just more apartments, which creates the need for more storage. In Texas is a newer, you know, more recently developed area as compared to, let's say, something like New York City, right? That's very old, so I'm not familiar. There's probably plenty of storage there, but in Texas, North Texas specifically, it wasn't until the mid 90s that you started really seeing a lot of self-storage properties. So they're more recent. You know, there's still room for growth in that asset class in the Texas market. Before I give my contact info, were there any other questions?
Yes, a couple more questions that popped in. It says, do you have a minimum investment requirement?
So we typically, we've done anywhere from as low as 25,000 up to 100,000. And it just depends on the size of the deal. The larger the capital raise, the larger the minimum investment will be. Just because, as I mentioned, there's a limited number of non-accredited that we can take, so that makes sense to, you know, not have such a low minimum. You know, anywhere from 25 to 100 usually, and we can negotiate even if we set the minimum at a certain level. You know, we've been asked before, can you accept a smaller investment, and we've done that several times.
Okay, next question is, what should an investor look for when evaluating a sponsor or syndicator? Like, what questions should they be asking you?
Yeah, very good. And as one myself, I do this myself. First of all, I would look at, so I get asked this question a lot. What's more important, the location or the sponsor or the market or the property? And it's really all of the above. That sounds like a political answer, but it's really, you have to look at all of the things. You have to look at, you know, crime in the area. You have to look at growth in the area. Demand, is it oversaturated with self-storage already? Does it have the value add components available? You know, are the rents below market? You have to look at the rent comps, the sales comps, and just compare like to other properties nearby. Is there room to raise rents on this? And if there's not, then it may still work, but there's more risk, right? So you want to just see if there's you know, value add opportunity. The experience of the sponsor, you know, have they you know, done deals in this market before? Is this their first deal in that market? You know, I would want to make sure at least someone on the sponsorship team has experience in the market, and that someone lives locally. You know, I as much as we talk about automating these properties, I still would be wanting to go check on it every now and then, because you can't just 100% rely on property management. You got to oversee it. So, for example, we found some erosion issue on one of our properties that probably we wouldn't have been told about until it was worse. So it's good to just walk the property, and someone should be local there. So those are the things I would look for.
Okay, a couple more questions that popped in. It says, any open or ongoing capital raises for self-storage?
Not at the moment. We just completed one, but if here's my contact info. If you reach out to me, I can add you to my list. And then again, that could change. We have several offers in, so we at any moment we could be having another one available. So would love to connect and keep everyone up to date on any opportunities.
Okay, and I know you touched on this during the presentation, but the question is, how do you evaluate, or how does your team evaluate which facilities you're going to potentially invest in?
Yeah, so we look for the value add. We look for recently I'm really looking at seller financing, where we just negotiated a 4.5% interest rate with 5 years of interest only, which is really helping the cash flow on the example we just showed. So versus if we had used a regular loan, we wouldn't have been at that 10%. It would have been much less. So we look for seller financing opportunities. And now as the economy improves, we'll be back to normal, right? But for now, that's what we're doing. And again, the value add, we got to have some room in the rents to move rents. You don't want to buy a property where they're the most expensive rents in the area. It's just not smart because you just don't have the wiggle room to increase that NOI. So we look for value add, and some of the things I mentioned, of course, about the neighborhood, the crime, and just make sure it's stable. We like to buy something stable. That's another thing. I don't like the heavy lease up. While that's an opportunity for a massive gain, it's very risky. What if you're not able to lease it up? If you're buying a property at 40% occupancy, and you need to get it up to like 85, what if you're not able to, right? So I rather buy a property that's already proven to be stable and cash flowing for the last 12 months. And that way you just step in and continue. And then you can add your other income drivers to even increase it even better. So those are what we look for.
Okay, and next question that came in is, what is the requirement to become an accredited investor?
So that at the moment, I believe is a 1 million net worth, not including your primary residence, and or 200,000 a year income for individual, or 300,000 for married joint filing. Now, at some point, they will probably update that in the future, but that's what it is currently.
Thank you, Joe. If you have any other questions, feel free to put those in the question box. But so far, that covers it, which brings us, close to top of the hour. So we're making good timing. If you have any questions related to self-directed IRAs, Advanta is here to serve you. Feel free to reach out to myself or my colleagues. Anything related to self-storage that that Joe mentioned today and you're interested, you have his contact information. You can reach out to him directly, and I'm sure he'd be happy to talk anything and everything related to self-storage. Okay, thank you, Joe. I appreciate you being our speaker today. Thank you, everyone, for taking the time to join us. Again, any questions related to self-directed IRA, feel free to reach out to me at Advanta IRA. And also anything related to self-storage that Joe mentioned, you're welcome to connect with him. This will be on a YouTube channel later today. I also have a copy of Joe's slides, so if you want them, you're welcome to just send me a quick email. Joe, any parting words before we disconnect?
Yeah, and just to mention, I should have put it on the slide, but my website is just breakchaincapital.com, so the same thing in the email. If you go to breakchaincapital.com, you can see some of our other properties and learn more about us. And you can sign up for our contact list on there, or just email me and I can put you on it.
Sounds good. Happy investing, everyone. Thank you, Joe.